Well, we are wrapping up March and heading into April. And here's a question for you. What does the war, the rising price of oil, and increase in bond yields have to do with the housing market? Well, they're all having upward pressure on mortgage interest rates. Let me show you what's happening. Well, this is the latest article from homes.com last week, which mentioned mortgage rates hitting 6.38% as war sends the oil prices higher. And they note in this article at the time that was a 40 basis point jump, and that increased an average mortgage payment about $100 a month. But it actually gets a little worse than that. Right now, as we sit this week, we are starting at 6.64%. So it is a 65 basis point hike over the last month since the war began. Let me show that to you in a chart just to tell you kind of how it happened. So here we are on the 30-year fixed. If we go back pre-war announcement, we were really coming down. We were in the 5.996% range. This is late February. You know, the housing market was seeing a lot of signs in Austin, not nationally, but in Austin of some recovery. We had more pendings. We had more activity on showings. Boom, then we announced the war. And yes, it spiked up, but only about 10 basis points, 10 or 15. It didn't go nuts until the Strait of Hormuz got shut down. That, of course, then inflates oil and creates a lot more uncertainty, which makes the bond market go up. And then we really see rates kind of take off from there. So over the last 2.5 weeks, we've really seen mortgage rates take off. Now, it's volatile. So this could be a day-to-day, week-by-week move in the interest rate. So pay attention to that because it is going to impact at least sentiment with buyers. It may or may not impact exactly if they're going to buy or not, but it might impact sentiment. Here's what it's going to do to their buying power. And again, this all happened in 4 weeks, essentially. So let's assume they could get 5.99 and now a buyer today is 6.64. So it's this article in Inman, which is one of our industry websites, says how much can a buyer really afford? Well, let's assume they use these same metrics. At 5.99%, they could borrow a little over $353,000. And now at 6.64%, that drops to $331,000. So it took out about $22,000 in buying power. So if they were buying at the right, they were hunting at the top of their range a month ago, maybe that was 650,000 or 400,000, whatever their home price is. Well, now they're going to have to knock down a peg, or they're going to have to negotiate some stronger terms with the seller. That's what's happening when interest rates spike like this. So if that's what's happening on the for sale side with interest rates, well, what's happening on the rent side? Well, this article last week talks about how housing policy reforms over the last decade led to huge growth in Austin in rental units. And of course, what did that do? Created rent declines. So we increased our housing stock by 120,000 units. That's about the size of Round Rock. That's how many units we built in Austin, a 30% increase in housing stock. Which greatly outstripped the national growth rate of 9%. So we tripled what most cities were doing in terms of building. What's that done to rents? Well, our rents have come down. So while housing has stayed, we'll call it more expensive, at least from a borrowing point of view, I think the prices have come down significantly, but so have rents. And so this is just over the last year. This is the last 12 months. Austin leads the nation in a 5.9% rent decline, while you have maybe tighter markets like Virginia, maybe on the high end, they're seeing rents going up about 5%. The blue dots, which is pretty much the entire South, Southeast, you've got the Mountain West. Those are the areas where rents have come down. If you look at tight markets like the Bay Area and San Francisco or the Northeast, parts of the Midwest, that's where you're seeing rents go up. So it's been good for the renters. So we're now making headlines. New report declares Austin a top 10 hotspot for Gen Z renters. So let's make it real simple. When housing feels expensive and rent is cheap, what are people going to do? They're going to rent. And so right now, people are staying in the rental market longer. They are getting their deals on rent. That's not going to last forever. But for now, that's also what's led to a bit of an anemic housing market is, yes, there's people here that will buy, but we added a round rock of empty units on the market that now need to fill up. People are filling them up. We're adding 30, 40, 50,000 people a year to the metro. but it's going to take time. And this year, they're kind of predicting we might finally be kind of filling these units up. So we're really going to see over the next 12 or 24 months how that starts to shift that rental market, which can then start impacting the for sale market. All right, here's a couple more up-to-date stats for you. This is active versus sold listings right now. And you can see the green are the listings. So here we go. We're starting the spring. You see that rise in listings. It's still not the end of March. I expect we will have more blue sales once we get into early April and look backwards. We'll be able to see that blue line higher than the March line. Higher than the February line. The March line will be higher. So I expect we're going to see sales going up too, but we're going to have a big gap. That's pretty standard. We have a lot of listings. We have some buyer activity, but we're waiting to see where that's going to peak out in the spring. This one right here is original price, which is green, versus sold price. Okay, original price versus sold price. And again, it's going to mirror kind of that inventory pattern. But what typically happens is this is price, not number of units. So what's happening is this right here was last year's peak in April. This is optimism. This is sellers listing properties. You're listing at a higher price. Doesn't mean you're going to sell at that price. Look at the gap between kind of the average asking and the average close. But what's happening is the list prices come down because you peak out in inventory. There's more, fewer buyers kind of heading into late summer and fall. And what happens is sellers have no choice. You got to lower that price. You got to get down to, where buyers are. So these are starting prices. That means sellers start to list at a more conservative price as you get through the year. And here we go again. Here's the spring. We're seeing prices going back up. And also you might be getting some higher priced inventory as well hitting the market. But you're going to always have this spring optimism in price. You're seeing some sales follow along. So sales are going up too in terms of price, but I expect we will see that peak off. The only thing that can change that is right now we have these higher, we'll call it higher interest rates kind of coming into the market. If things are going to change with the war effort or the bond market, and we see that reverse course and interest rates really start to drop, let's say more aggressively the second half of the year, that could create a different environment than we're used to. So we're going to have to really watch interest rates as we move forward. If you are a seller right now, you just need to be conscious of the fact that your buyers have to pay, if they're borrowing money, a higher price than they did just 4 weeks ago. So it is affecting them. And of course, everybody's watching the news, so it could slow some people down on their decision making. However, we are hearing so far the new listings are getting good traffic. We're hearing multiple offers in a few occasions. So anyways, we're still seeing data that is telling us this spring is performing a little better than last spring. So until that changes, that's how we're looking. If you're a buyer right now, I think you really want to think about not stopping the search, but you want to think about how you want to negotiate the deal. Do you want to ask for more credits from the seller to help you negotiate down that interest rate, make it a smoother process, and also be in touch with your mortgage lender weekly if you are in the process of actively writing offers so they can run real-time numbers for you? It's not always as aggressive as you think in terms of mortgage payment, but it's important to note how that's playing out. Anyways, I hope these videos are helpful. I will be making them every Monday. You can follow along on our YouTube channel at Ryan Kelly Group and click that subscribe button. And of course, if you know anybody looking to buy, sell, invest, or finance here in Austin, we'd love the opportunity to help you out. Well, of course, it's Easter week. Hope you guys have a good one, and I'll talk to you next Monday. Thanks.